When you had a job, taxes were simple. Your employer took money out of every paycheck and sent it to the IRS on your behalf. You never had to think about it. April came around, you filed your return. Maybe you got a refund, maybe you owed a little. The system handled itself. The moment you retire, that entire system stops, and nobody explains what replaces it. There's no welcome to retirement letter from the IRS. There is no checklist in the mail. There is no phone call from Social Security telling you what to do about taxes. You go from a system that ran on autopilot to a system where every single decision is yours and every single mistake costs you money. I have watched retirees lose thousands of dollars in their first 2 years of retirement, not because they did anything wrong, because they did not know what the IRS expected them to do once the paycheck stopped. Today I'm going to give you the complete list, 10 things. All of them matter. Most retirees miss all of them. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retires. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let us get into it. Number 1, set up estimated tax payments or you will pay a penalty. When you were working, your employer withheld taxes from every paycheck. That withholding covered your income tax, Social Security tax, and Medicare tax. The system worked automatically. In retirement, your income comes from different places: Social Security, a pension, IRA withdrawals, dividends, maybe rental income. And here's the problem. Most of those sources do not withhold enough tax. Social Security withholds a flat percentage only if you ask for it. And even then, it is usually not enough. IRA withdrawals often have a default 10% withholding, but your actual tax rate might be 22%. If you do not pay enough tax throughout the year, the IRS charges you an underpayment penalty. The rate changes quarterly based on the federal short-term interest rate. For the first quarter of 2026, the rate is 7%. For the second quarter, it dropped to 6%. The penalty is calculated daily on the underpaid amount for each quarter. The fix is to make quarterly estimated tax payments. The deadlines are April 15th, June 15th, September 15th, and January 15th. Go to irs.gov/payments and set them up. The safe harbor rule says if you pay 100% of last year's tax liability through withholding and estimated payments, you will not be penalized regardless of what you owe this year. 110% if your income was above $150,000. Let me put a dollar amount on this so you understand the stakes. Say you retired in 2025. You are 66 years old. You collect Social Security, withdraw from your IRA, and have some dividend income. Your total tax liability for 2026 ends up being $14,000. You had $8,000 withheld through the year from various sources. That leaves $6,000 underpaid. You did not make any estimated payments because nobody told you to. The IRS calculates the penalty on that $6,000 across 4 quarters at the current rate. When you add it all up, you're looking at roughly $300 to $400 in penalty on top of the $6,000 you already owe. Now here is something most new retirees do not know. The IRS does have a waiver specifically for seniors. If you are 62 or older and you retired in the last 2 years and you had reasonable cause for underpaying, they can waive the penalty entirely. but they do not apply it automatically. You have to file Form 2210 with your tax return and check the box for the waiver. If you just file normally and pay the bill, you will pay the penalty and never know the waiver existed. Number 2, file Form W-4V to withhold taxes from your Social Security. Most retirees do not realize their Social Security benefits can be taxable. If your combined income exceeds $25,000 as a single filer or $32,000 married filing jointly, up to 85% of your benefits can be taxed. You can have federal income tax withheld directly from your Social Security check by filing Form W-4V, Voluntary Withholding Request, with the Social Security Administration. You choose from 4 flat rates: 7%, 10%, 12%, or 22%. You can also set this up online through your My Social Security account at ssa.gov. This takes 5 minutes and it prevents the surprise tax bill that hits millions of retirees every April. Number 3, understand the provisional income formula that taxes your Social Security. The IRS uses something called provisional income to determine how much of your Social Security gets taxed. It is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. If that number is between $25,000 and $34,000 as a single filer, up to 50% of your benefits are taxable. Above $34,000, up to 85%. For married couples, the thresholds are $32,000 and $44,000. Those thresholds were set in 1983 and 1993. They have never been adjusted for inflation. A combined income of $25,000 in 1983 meant you were doing well. Today, it is a modest retirement. This frozen threshold now catches 56% of all Social Security recipients. Every dollar of additional income you bring in does not just get taxed at its own rate. It can push more of your Social Security into the taxable zone. The effective marginal tax rate for retirees in this income range can be 30 to 50%. Because each dollar triggers taxation on benefits that were previously untaxed. Understanding this formula is how you control your tax bill in retirement. Number 4, claim the $6,000 senior bonus deduction. The One Big Beautiful Bill created a brand new deduction for taxpayers 65 and older. It is $6,000 per person, $12,000 for married couples filing jointly, where both spouses qualify. This is on top of the regular standard deduction and the existing additional standard deduction for seniors. The income limits are $75,000 for single filers and $150,000 for married filing jointly. Above those limits, it phases out. Below them, full benefit. This deduction is available for tax years 2025 through 2028. It goes on the new Schedule 1A. Not all tax software is flagging this deduction automatically. Ask your preparer specifically whether they applied it. If you already filed without it, you can amend within 3 years. Number 5, know when your required minimum distributions start and never miss one. If you have a traditional IRA or 401k, the IRS requires you to start taking minimum withdrawals at age 73. These are called required minimum distributions. The amount is based on your account balance on December 31st of the prior year, divided by a life expectancy factor from IRS tables. You must take your first RMD by April 1st of the year after you turn 73. Every RMD after that is due by December 31st of each year. If you delay your first RMD to April 1st, you'll have to take 2 RMDs in the same year, which can push you into a higher tax bracket. The penalty for missing an RMD is 25% of the amount you failed to withdraw under the Secure 2.0 Act. That drops to 10% if you correct it within 2 years. But that is still a massive penalty on money you were going to withdraw anyway. Here is a real example. You turn 73 in 2025. Your IRA balance on December 31st, 2024 was $500,000. Your RMD for 2025 is approximately $19,200 based on the IRS Uniform Lifetime Table. You have until April 1st, 2026 to take that first RMD. But if you wait until April, you also have to take your 2026 RMD by December 31st of that same year. That means 2 RMDs in 1 calendar year. Roughly $38,000 in IRA withdrawals hitting your tax return at once. That can push you into a higher bracket, make more of your Social Security taxable, and trigger IRMA search charges on your Medicare premiums. Taking your first RMD in the year you turn 73 instead of waiting until April avoids the double hit. Number 6, use qualified charitable distributions to satisfy your RMD tax-free. If you're 70 and a half or older, you can donate up to $111,000 directly from your IRA to a qualifying charity. This is called a qualified charitable distribution. The donation counts toward your RMD, but it does not count as taxable income. It does not increase your adjusted gross income. It does not push your Social Security into the taxable zone. It does not trigger Medicare or May search charges. If you are going to give to charity anyway, routing it through a QCD instead of writing a check from your bank account is dramatically more tax efficient. Same donation, different source. Thousands of dollars saved. Number 7, consider Roth conversions during the gap years. The years between retirement and age 73, before RMDs start and potentially before you claim Social Security, are called the gap years. During those years, your income is often at its lowest. Your tax bracket is at its lowest. This is the optimal window for Roth conversions. When you convert money from a traditional IRA to a Roth, you pay income tax on the amount you convert. But once it is in the Roth, it grows tax-free. Withdrawals are tax-free, and there are no RMDs during your lifetime. The tax you pay now at a lower rate saves you from a higher effective rate later, when Social Security, RMDs, and IRMA all stack on top of each other. A down market like we are experiencing right now makes Roth conversions even more attractive. You convert at a lower dollar amount, pay less tax, and all the recovery growth happens inside the Roth tax-free. Let me show you the math. Say you convert $50,000 from a traditional IRA to a Roth while the market is down. You pay income tax on $50,000. If the market recovers 20% over the next 2 years, that $50,000 grows to $60,000 inside the Roth, completely tax-free. If you had waited until the market recovered to convert, you would be converting $60,000 and paying tax on the full amount. At a 22% bracket, the down market saved you $2,200 in taxes over a decade of conversions. That adds up to tens of thousands. The ideal strategy is to convert just enough each year to fill your current tax bracket without spilling into the next one. A tax advisor can help you calculate the exact amount. Do not wait. Every year you delay is a year of conversions you cannot get back. Talk to your advisor this week. Number 8, watch out for IRMA, the Medicare premium surcharge nobody warns you about. HERIA stands for Income-Related Monthly Adjustment Amount. If your modified adjusted gross income exceeds certain thresholds, Medicare adds a surcharge to your Part B and Part D premiums. The search charge is based on your tax return from 2 years prior. For 2026, the first bracket starts at $106,000 for individuals and $212,000 for married couples filing jointly. Above those levels, your Medicare premiums can increase by $70 to over $400 per month per person. A single large IRA withdrawal, a Roth conversion, or one-time capital gain can push you over the threshold for 1 year and increase your Medicare premiums for the next 12 months. If this happens because of a one-time event, you can file Form SSA 44, Medicare Income-Related Monthly Adjustment Amount, life-changing event with the Social Security Administration to request a reduction. Number 9. Update your address with the IRS and never ignore their letters. If you moved when you retired, the IRS may still be sending notices to your old address. File Form 8822 to update your address. This is free and takes 5 minutes. Every IRS letter has a deadline. Miss that deadline and you lose your right to dispute, appeal, or negotiate. The IRS does not care about your excuse. They care about the date on the letter. If you receive a notice and you're not sure what it means, do not put it in a drawer. Open it immediately. If it is a CP-14 notice, it shows a balance due. If it is a CP-2000, the IRS thinks your return does not match their records. If it is an LT-11 or Letter 1058, it is a final notice of intent to levy, and the IRS can take action in 30 days. Number 10. Run the numbers on standard deduction versus itemizing every single year. The standard deduction for 2026 is $16,100 for single filers and $32,200 for married filing jointly. On top of that, seniors 65 and older get an additional $2,500 per person. And on top of that, the new senior bonus deduction adds up to $6,000 per person. For a married couple, both over 65, the combined standard deduction plus both senior add-ons plus the bonus deduction can exceed $47,000. That is a lot of income that is completely tax-free. But the SALT deduction cap just jumped from $10,000 to $40,400 under the One Big Beautiful Bill. If your state and local taxes plus mortgage interest plus charitable contributions exceed your standard deduction amount, you should be itemizing. Millions of homeowners switched to the standard deduction in 2017 when the cap was $10,000 and never looked back. The cap has changed, but their filing habits have not. Run the numbers every year. Do not file on autopilot. The difference between the right choice and the wrong one can be thousands of dollars. Let me give you a quick example. A married couple, both 67, living in New Jersey. Property taxes $16,000. State income taxes $9,000. Mortgage interest $4,000. Charitable contributions $3,000. Total itemized deductions $32,000. Their standard deduction with both senior add-ons and the bonus deduction is about $47,000. Standard deduction wins by $15,000. They should not itemize. Now take the same couple in Connecticut. Property taxes $22,000. State income taxes $14,000. Mortgage interest $8,000. Charitable contributions $5,000. Total itemized deductions $49,000. That exceeds their standard deduction by about $2,000. They should itemize. And if they have been taking the standard deduction on autopilot since 2017, they have been leaving $2,000 a year on the table. Over 5 years, that is $10,000 gone. The SALT cap change from $10,000 to $40,400 is the single biggest reason to rerun this calculation in 2026. If you live in a high property tax state and you have not checked since the cap was at $10,000, check now. Let me bring it all together. Here are all 10 in order. 1. Set up estimated tax payments before the next quarterly deadline. 2. File Form W-4V to withhold taxes from Social Security. 3. Calculate your provisional income so you know how much of your Social Security is taxable. 4. Claim the $6,000 senior bonus deduction on Schedule 1A. 5. Know when your RMDs start and never miss one. 6. Use qualified charitable distributions to satisfy your RMD tax-free. 7. Do Roth conversions during your gap years while your tax bracket is lowest. 8. Watch for IRMA and avoid one-time income spikes that raise your Medicare premiums. 9. Update your address with the IRS and open every letter immediately. 10. Run the numbers on standard deduction versus itemizing every single year. 10 things. The IRS expects you to know all of them. Most retirees know 0 of them on the day they retire, and every single one you miss costs you money. This is Kevin Retires. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. The videos I'm working on next could save you thousands of dollars. If you know someone who just retired or is about to retire, send them this video today. This is the checklist nobody gives you on your last day of work. Drop a comment. Which of these 10 did you not know about? I read every single one, and the most common questions become future videos. I will see you in the next.